G'day guys, welcome to another episode of the Pumped on Property Show. I'm here with Simey today, and in this one, we're going to be giving you an update on the Australian property market, the economic conditions at hand at the moment as of the month of August. I'm pretty excited about this one, to be honest with you.
Yeah, it's going to be good to unpack this in a little bit more detail. Obviously, certainly a lot of negative consumer sentiment out there at the moment, and it's kind of nice to peek behind the curtain, actually look at the data, look at the numbers to see what that sentiment is resulting in the actual market when we look at the numbers.
You know, what's interesting for me with this sort of stuff, bro, is obviously we get direct feedback every day or every month from hundreds of investors, and then we're reading all the time. But when we actually put it down on paper like we do to prepare for this one, it's kind of like, it's a pulse check. It's just that constant pulse check. And we hope that you guys are enjoying these updates and sort of able to use these either to sort of do nothing and chill for a bit or to take advantage of market conditions as they pop up as well.
For sure. Now, apologies if there is a little bit of feedback in the microphones. We've got some work happening at the house today. Boys are working hard out there. We're working hard in here.
They're putting a little bit of, what are they putting down? A bit of a base for me because I've got a new skate ramp actually going in tomorrow, which is going to be sick. A little 2-footer for the kids / me.
Ben had to downsize because the 3-foot ramp was too big.
The 3-foot ramp was too much, eh? So yeah, a little playful 2-footer. It's going to be sick. But getting into the market update, man, let's talk a little bit about CoreLogic at the moment. So CoreLogic collects all of the data and then just puts what's happening on a daily, weekly, monthly, quarterly, annual basis out there. Now, everybody knows at the moment, if you've been following our stuff, that Sydney and Melbourne were due for a bit of a correction. They're now going through that correction at the moment. In the quarter, I think Sydney's down 4.8% and Melbourne's down 3.3%.
Not too bad.
Not too bad. The likes of CoreLogic, SQM, and the big banks are saying that Sydney could be down, by the end of a year by as much as 15%. Melbourne could be down as much as 10%. There's a whole bunch of fear-mongering going that it could be much worse than that, but we'll see what happens.
Yeah, only time will obviously tell there, and we'll see how bad the bleeding actually gets down in those markets. But I think it's important to understand that these markets have seen significant capital growth over the last 5 to 10 years. So generally when you get big booms, you might get a bigger correction as well. And when you actually look into the numbers and the split of where the declines are happening the most, CoreLogic actually tells you that it's the upper quartile of the market. So the most expensive properties in Sydney, the most expensive properties in Melbourne, the most expensive properties around Australia are the ones seeing the biggest declines at the moment, where properties that are more affordable and haven't seen as much growth are remaining relatively stable at the moment.
One of the things that I noticed as I started to think back on the last 7 years that we've been actively buying like we have is in COVID, the last time we saw this, at one point, Sydney, Melbourne, Brisbane prices, you could sort of pick stuff up for about 10%, maybe even 15% below market value for about the first 9 months while the fear was the worst. Obviously, the year didn't end up that way because people got very heavily involved in investing again. And then back in 2017, 18, when APRA really stepped in hard, I think there was a point where Sydney prices went down by about 12 to 15% for a period of time that year, and then so did Melbourne, about 10 to 12%. And then again, they sort of come back. So what's interesting right now that I can see is, even though these quarterly averages look pretty low, like Brisbane's less than a 1% drop, Adelaide's still up for the quarter, so's Perth, is I actually think because there's more supply of property right now and less demand in terms of buyers, we are able to pick up things at the moment for below market value. It's the first time we've been able to do that since the start of COVID.
Yeah. And then when you look at the annual results around Australia, things are all looking pretty good. Every single market, when you look at the 12-month average, the annual average as of July 2022, every market around Australia is still turning positive results, albeit Sydney and Melbourne very low positive results. But what have we got in actual numbers there?
Sydney's up 1.6% year to date. That's going to be negative real quick by the next quarter. Melbourne's up 0.5%. But Brisbane's still up 22% for the year that we're in. Adelaide's up 24%, Perth's up 5.5. But I'd say that those numbers, when we look at them in 12 months, will look significantly different. So some of the other stuff coming out from CoreLogic's around rentals. We've seen a major spike during COVID in demand as a lot of people from overseas came back to Australia, expats living overseas, tourists that were over there as well. And a lot of those people actually came back to their investments instead of continuing to rent them out. They obviously took over them as well. So rents have gone up in almost every capital city in Australia, except maybe Sydney and Melbourne in terms of that inner city unit market. But I heard that's even starting to pick back up again.
Yeah, the hard thing is, this rental crisis, it isn't going anywhere because there's no new supply necessarily coming to the market. Well, not any meaningful supply coming to the market. And then you add the expats coming back, but now international tourism picking back up, soaking up a lot of the inner city apartments and Airbnbs. Nowadays, we're seeing vacancy rates on the national level sitting around 1%, 1.1% according to SQM. You look at all capital cities outside of Sydney and Melbourne, they're all sitting below 1% at the moment. And the natural reaction from this is going to be increased rents, and CBA came out a while ago indicating they see rents going up in some parts of Australia between $100 to $200 per week. So it obviously is great for the landlords and property investors to hedge against the interest rate rises, hedge against inflation, get a little bit more cash flow coming in. But unfortunately, it really hurts tenants. It hurts the lower socioeconomic demographics. And with the cost of living going up, these people are going to be more negatively affected, unfortunately.
It's unfortunately the way house prices go up and then rents go up to collect it. The good thing is at the moment in many industries, we are having a little bit of a jump in wages. And so, as rents have gone up, some wages have gone up too. But I know there's many people hurting in the current market too, which I suppose is forcing people into lower quality housing, cheaper housing further from the places that they truly want to live. I hope over time the Australian government gets this balance right. But unfortunately, with a goal to get to 60 million people and the government taking so much money out of property and their local councils constantly blocking developers from doing more work at the moment, and the banks, because of the Australian government, making it really hard for developers to access cash, I think this issue is going to get significantly worse before we end up oversupplied. And we will be talking in 10 years about oversupply again.
Yeah, of course.
That's just what happens.
Yeah, it all runs in a cycle, right? And right now we're in an environment where rents are currently rising. But obviously that will change at some point in time. But it's just good to recognise the flow-on effect of government decisions around Australia.
Without a doubt. So SQM's another source of our monthly updates as well. We always like those guys. They've said that listings, in terms of the number of properties for sale, are actually up. It's really funny that they say that because they're actually down 30% on the 5-year average still.
In Brisbane, yeah.
So you'll get these articles, going, listings are completely up Australia-wide. And then when you actually look at the numbers, they're still so down on where they were. There's still significant demand there. We've got some suburbs at the moment where we might be competing against 1 to 3 people on a property on the weekend. There's some other properties, like Ben told me in our team, that a property sold 80 grand above market value in southwest Brisbane. And there was something like 7 or 8 written offers on it last weekend. So it's just a mixed bag. Parts of Perth, I've heard, are going nuts right now as well. Same with parts of Adelaide.
Look, it's natural. It's, I think, ignorant to look at Australia being just one big market.
Yeah.
It's not a reality. There's so many different factors that come into play, and, just the fact that inflation is here and interest rates are rising, it doesn't mean that it's going to be a negative story for the entire Australian economy and property market. It is going to be specific markets that are going to feel it a little bit more so than others, but there's always going to be winners and losers in this industry. It's the only constant, right?
100%. One of the things that's interesting at the moment I've been seeing in the mainstream media is this conversation around distressed sellers, distressed properties. The number of distressed properties are slightly up on a couple of months ago, but Australia-wide, they're literally sitting at half of the 2021 levels, which means people are paying their mortgages on time, and in many, many households, 30% of Australians own their households outright. Another 30% have an LVR below 50% with a very small amount of debt. Australia-wide, according to the ABS, the average income to how many years it takes to pay back the debt that they have on their home is about 4, maybe 4.5 years. Like it's
Wow.
still way within a reasonable long-term level. It's just when that new first-time buyer puts a 5% deposit down in Sydney, that's what the media is reporting on at the moment as like, you know, this issue coming.
And look, you know, for a lot of people that have purchased properties in Sydney at the very top of the cycle, now we're starting to see a decline. You know, they're the types of demographics that unfortunately are going to feel this environment a little bit more so than others. But it's not going to be Australia-wide. It's not going to be every single person. It's going to be the minority. And, you know, unfortunately, it is going to be a bit challenging. But the best thing about Sydney and Melbourne, give yourself 15 or 20 years, your property's probably going to double from where it's at right now.
Absolutely. Other things that SQM was saying is the average time on market is a little bit longer now. So the number of properties that didn't sell in the first 30 days have started to increase in Australia, and time is beautiful as an investor.
Absolutely. I'm loving it at the moment in the current market with being able to negotiate a little bit harder, you know, play the game with the agent, not have to see a property, put an offer on it on that day and close the deal on that day. You're sort of getting a little bit of extra time, maybe, you know, 3 to 5 days throughout that negotiating period, and starting to see far more below market value opportunities as well.
It's cool because like last year and up until about maybe February this year, there were people that had been trying to buy for 2-3 months in many parts of Australia, even up to 6 months. And these were the people that were coming in Sydney, Melbourne, parts of Brisbane, putting offers in 20 to 100 grand above asking price. And now that there's time, people aren't doing those silly things. So yes, the capital gains are looking lower, but the ability to buy is just so much better. And that's why the average vendor discount's increasing a little bit. And that's why I think we're in a buyer's market as well. Like, it's absolutely beautiful.
Now, some of the fascinating information that we're seeing coming out at the moment from a real diverse range of different people, economists, analysts, property investors, banks, a bunch of different people, talking about this interest rate rising environment, and what basically every single one of them are saying is that interest rates are rising really quickly and really fast and really strong. It's really to hedge against inflation, because the RBA implemented this quantitative easing program back in 2020 to obviously ease the impacts of the global pandemic, and this created a lot of additional money in the system, a lot of extra savings, and spending went through the roof. When you actually see the scale of spending versus like the 20-year average in 2020 and 2021, after the JobKeeper and JobSeeker payments were released, went absolutely through the roof. And because that demand went absolutely skyrocketing and we had all of the supply chain issues around the world, you're seeing this mass inflation at the moment. The RBA is forced to implement this quantitative tightening cycle, which is where they're rising interest rates to slow down inflation, to slow down Australian spending. And it's working like a storybook at the moment.
It is.
And what they actually all expect is by H2 2023, it's about 12 months from now, is for the interest rates to start reversing and coming back. Now, as of the most recent interest rate rise, the cash rate's sitting at 1.8%. CBA expect this to get to about 2.6% at some point by the end of 2022. They then see it sitting flat at 2.6% up until the middle of next year. And then we're going to start to see a bit of a reversing of those interest rates, which makes me sleep better at night, knowing that it's only going to be short-lived, these really high expenses in my life, higher mortgage repayments and things like that. But the good times should be back in no time at all.
You know, when you actually think about it, it's pretty messed up. But this is how it's been for hundreds of years, right? Since banks started to lend money with interest. In fact, people have been doing that for thousands of years around the world. And all it is there's too much money in the system, we pull the handbrake and we stop it, we slow it down. There's not enough money in the system, we pump it and we chuck fuel on the fire and it goes off again. And the central banks around the world can never get this right. They're always slightly behind the curve. They normally stimulate too late, or they overstimulate too early. And it's so tough. Like, we're talking about such complicated things.
Yeah, big money, right? Like, how much money is Australia making in a year? Like, what's the GDP, right? So it's a lot of money. It's a lot of people to try and, manage and make sure that everybody's happy, everybody's healthy, everybody's financially stable. So it's got to be challenging, and, I would hate to have their job, but it is an unfortunate reality of the capitalist system that we operate under.
Completely. So what this actually means for you guys is if the cash rate's at 2.6%, which is the money that the banks get lent to from the Reserve Bank, then they want at least the 2, maybe 3% margin. They'll try and get away with it, whatever margin that they can get, because every bit of margin is profit for them. So
APRA won't let it get too high, hopefully.
I don't know. Who knows? We don't know any of this stuff, right?
But no, not at all.
This working best case scenario means that our rates would be, by the middle of next year, 4.5 to 5.5%, which is extremely low historically. Like, when I started investing, I think they were at 7 to 9%. And people will get used to that at some point. But then if Simon's right, based on what they're saying, and they do start peeling them back, like Commonwealth Bank's saying to their high net worth clients that we could see rates as low as 3.5 to 3% retail again within 12 months from today. But what we need to say as a huge disclaimer here is, if inflation doesn't get under control, the main lever that they have to pull is they'll just keep jacking rates until we stop spending and people don't have cash over left to do it. The problem at the moment, and they talk about this in CBA, Core Logic at the moment, and the RBA, is they're trying to stop inflation and pull it up, but they also know there's vulnerability in the global financial system and they don't want to pull it up too high. And so there's this so fine line that they're treading right now, because if rates do get up to 7% or 6% and all these people come off from 1.2 to 1.9% rates, we could have a whole bunch of issues, and that's what they're trying to manage and mitigate at the moment. That's why they were going to put it up a little bit for 2 years. Now they're just putting up a hell of a lot and then the media's come in and freaking everyone out at the same time, which is great.
It's
to sort of slow it down.
Slowing down the inflation. And the forecast for the RBA is they see inflation getting to about 7.5%, which is good. We've managed it better than Europe and America. Not getting too crazy, but still well above where we want. And I believe that they were saying they see it coming back next year to, around the 4 to 5% range for inflation. And then by 2023, back to the sort of target rate, 2024, back to the target rate around 3%.
Can I just say something about all this stuff? None of us, including these guys, have a fucking idea.
Yeah, we're all trying to predict the future.
In 2020, Commonwealth Bank expected house prices in Sydney to drop by 40%. They went up by 30%. If you look at the Reserve Bank notes last year, they expected inflation this year to be about the 1.4 to 2.2% range. It's 7%.
Super reactive.
It's just react, push. It's like the financial system is a 17-year-old car.
And this is why it is so important to not get too caught up in all the noise and all of the, turbulence of the short-term external situation, and just start focusing on the long term, because things will likely get better again in the future, and we will get used to this new norm. Property prices will continue to increase in the long-term future as well, and be a really sound asset for people to hold. And, that's what I'm more excited about. I'm liking, when I'm talking about Brisbane, I'm not talking about what Brisbane's going to be worth in 3 months, 6 months or 12 months. I'm talking about what it could potentially do over the next 10 to 15 years. Same down in Sydney, same down in Melbourne. And when you're not making short-term decisions and you're focused more on the long-term plan, all of these little short-term changes don't necessarily have a huge impact on your decisions.
I love that so much, man, because the strategy that you and I both have is 15 to 30 years.
Yep.
I'm noticing a lot more emails from my bank saying your rates have just gone up. But outside of that, I've known for a year and a half that rates are coming up. And we've been making that really clear to the guys that follow this regularly. It sucks for some people, these rate rises, but for most people, they can handle it. And it's just a case of rates are always going to bounce between 3 and 10% in Australia, because that's what they've done since there was central banking. governments around the world are always going to be slow to react or too quick to react on certain things. And it's like, if you can borrow money in Australia with the banks being so conservative, then most likely they are weighing up the risk and expect you to be able to pay. And if they say no, then there's a really good reason, because they expect that your risk is too high and you shouldn't be doing anything. So me and Simon never go all in. We've always got extra capacity. We've always got a savings buffer in place to protect our downside. We're constantly looking at our rent returns and talking to our managers once a year and making sure they come up in line with value. Yeah, like at the moment I'm refinancing because one of the major 4 banks put my rate up 1.5% higher than my current bank. So I'm refinancing and getting a better rate. And like in the current environment, with rates going up everywhere, like banks are pulling the hood over many people's heads and putting it up well above where people expect them to be. And you could go and refinance now, and most people, even with these rate rises, could probably save themselves 1% on their current lender.
Exactly.
And that's an exciting thing too.
Yeah, exactly. But look, it's important to look at all of these different analysts, look at all of these different advisors and economists to just get a more well-rounded approach, as opposed to just reading one article or just having a chat with a mate at Smoko. Like, I really value going into depth of the CoreLogic indices, reading all of the updates, all of the articles from SQM, from CoreLogic, from Michael Matusik, from CBA, from everybody that we possibly can, because it gives you a much more well-rounded approach, and it gives you some different perspectives to help formulate your plan and figure out what you want to do moving forward. But the reality is there's some tough times at the moment for a lot of households around Australia, but it's not going to last forever, and good times hopefully are around the corner.
You know, just to round it out, man, I 100% agree. You know, the likes of your Phil Andersons, your John Adams, your Simon Priestley's, like your Ray Dalio's, or maybe not so much Ray at the moment, he's at a different stage of his adventure. But your Fred Harrisons, like all of these guys, when you look at their forecasts, not this year, because everyone understands that Sydney and Melbourne are coming down right now, and that's okay.
And that'll impact the Australian average because they're such big markets.
Well, they represent, 50 to 70% of Australian sales. So when they go good, everything looks good. When they go down, everything looks pretty bad. But once people start to separate, well, Sydney and Melbourne have done 100% in 10 years. Parts of Brisbane have done 30 to 50%. There's other markets as well to look at. But what they're all sort of suggesting is over the next 4 years, which is insane, like they're expecting 30% growth. Some of them are expecting some markets to go up as much as 50 to 100%. And so that's why we collect ideas. We try and make the best decisions we can at the time with those ideas. I've personally just bought a property, even though I wasn't expecting to. I just like buying dips when they come through. And I was strategically missing a piece of my pie for where I want to be 15 years from now. So it wasn't the market's dipping, I want to grab something. It's more, I'm 50K short on my cash flow for where I want to be long term.
Yep.
I'm going to buy a property that can get me that now while it is on a discount. I wasn't thinking about rates, at 5%. Like I know I can cover a 5% thing because I know my rents on all my properties have already increased by $100 this year anyway.
And you forecast that.
Yeah, it was coming. It was timed, you know what I mean?
Yeah, you don't forecast your interest rates based on a 0% cash rate and a 1 or 2% interest rate. Like, it's great. It's a bonus. You use those times to build your buffers, to build your offset accounts, your redraw accounts and things like that, so that when these interest rates come up like they are right now, you've got a beautiful buffer. You've got, months or years of savings ahead of yourself. And, that's why it is important to do your risk management and make sure that you have those buffers in place and you forecast and you plan for the future. Like your spreadsheet, you forecast off 2, 3, 4, 5, 6, 7% interest rates. So you know what your cash flows are going to look like at different rates.
Man, 7% would really hurt me, eh?
I think it would hurt it,
a lot of people. But no, we wish you all the best, guys. We hope you've enjoyed this short update. We'll continue to bring these each month because it is good to get, some of the good things that are happening, some of the negative things. I suppose a few of the positive things are there's a lot of infrastructure spending, unemployment's super low.
Yeah.
International tourism's coming back. All of the international students are starting to come back.
Wage growth.
Wages are growing. Rental vacancy rates are the lowest levels in 30 years in most of Australia. There's so many positive things going on at the moment. And there's also some negative stuff with rates going up and the media at the moment, mainly the media, more than anything else.
The funny thing is like the most negative thing that is happening right now is consumer sentiment is down. So consumer sentiment means how are the consumers feeling about themselves or about the economy or about the markets. And, because people feel so negative about it, that actually does have an impact on how the actual markets perform. But it's good to know that the underlying fundamentals look quite good.
It's funny you say that, because I reckon like 99% of stock market speculation, crypto speculation or property speculation is people feeling good with good credit conditions, and 99.999% of every single recession that we've ever had, depression, is money being really hard. And when money gets really hard and people get in tricky situations, sentiment turns to shit. And when sentiment turns to shit and the herd moves away from markets like we've seen, they run way further into the ground than they should. And that represents a huge buying opportunity on both sides. It's just, it's always been like that. So it's always going to continue to be like that, unfortunately. No matter how many like incredible robots or programs we get running these things, the reality is people still over and underreact constantly.
For sure. I love that we get to we'll just start these market updates and then like one little sentence just triggers this thing in the mind, just like another 5 minutes unfolds. Thank you for listening through to the very end of all of these stuff, guys, because we're just nerds with this stuff. Like, I love looking at it. It helps me sleep at night. It helps me plan for the future. And it helps me make smarter decisions and try not get too attached to the external world as well, because all I can control is the way that I feel, the way that I set up my finances and accounts and the choices that I choose to make. Like, that's in my control, and I'm just going to focus on that.
Whew, that's a wrap. That's a wrap.
Have a spin. Yeah. Oh, sweaty. So sweaty.
Oh, that's good. That's so nice.
Oh.